Now I am moving on to the another provision, another important provision for your examination, that is section 94B, limitation of interest in certain cases. So you would have seen in every balance sheet, any balance sheet, there will be a debt, there will be a equity. So companies prefer to go for the debt portion even though they have a good market value, good reputation, good share price, etc. Why? Because when they take the debt, they have to make the interest payment. On that interest payment, they will get a deduction. If they get a deduction, that's a tax saving instrument. So basically, the interest portion is a tax saving instrument. That's why companies prefer debt. Okay. So when the companies prefer the debt, even these associated enterprises also take this as a tool to play with the tax. So what they will do is, one company is in India, another company is in USA. For example, USA company will provide the loan to the Indian company. So at the interest rate of 20%, the normal rate of interest for the particular loan is 10%, but they will charge 20%, and Indian company will pay the 20% amount to the US company. So thereby, Indian company is claiming the excess interest to the extent of 10% to their balance sheet, and they are lowering their profit and they are paying the lesser taxes. This is how the associate enterprises use this debt as a instrument to lower the taxes. That's why to tap that, to stop that, this section 94B was introduced. Now we are going to see the provisions and how the excess interest will be calculated, etc., etc. First of all, applicability. This section is applicable to all the Indian companies and the permanent establishment of a non-resident foreign company. The permanent establishment in India of a non-resident foreign company, that is also included here. Now, what is the nature of expense for which this particular provision is applicable? That is the interest expense, whether paid or payable. Interest expenditure, this section is applicable only to the interest portion. Now we'll go into the other areas. So other areas, the first thing that will come is debt. When I say interest, what kind of debt is covered? What kind of debt is covered under this provision? That is more important. So any loan, simply I would say any kind of loan which is bearing the interest which can be debited to the P&L is covered under section 94B. But as a reference, I'm just reading out this line. Any kind of loan, whether it is a short-term loan, long-term loan, secure loan, unsecured loan will be covered. Financial instrument. Financial instrument like debentures, bonds will be covered. Finance leases will be covered. Derivative also got covered. Or any arrangement that gives rise to payment of interest which is debited to the P&L will come under this provision. That is section 94B. Now I'm moving on to the another most important area. This is the important area in this provision, entire provision, that is amount of disallowance. When I say excess interest, so for example, if I can relate it better, you might have heard about section 40A capital A subsection 2 in the profits and gains of business or profession. What is the section is all about? If you make any payment to the related party in excess of the market price, which is unreasonable, excessive, that excessive portion will be disallowed, right? So similarly, same principle is applicable here also. So here also, the transaction between the loan transaction between the associated enterprises, the amount of interest which is in excess needs to be disallowed. Disallowance is restricted to the excess interest. Now the question comes, what is excess interest? So excess interest is lower of the following. So total interest paid or payable. So you need to be point to be noted here is total interest, not the interest between the associated enterprises. They are talking about the total interest. When I say total interest, all the loans on which this particular SC, particular associated enterprise is paying the interest. That means whatever the interest portion which is debited to the P&L needs to be taken here for the point number 1. So the total interest paid or payable. For the simplicity, let us take an example. Total interest paid or payable is 50. Total interest. I'm taking small numbers here for our understanding better. Okay, total interest paid or payable. Next one, in excess of the 30% of EBITDA. EBITDA means what? Earnings before interest, taxes, depreciation and amortization. That is called EBITDA. 30% of EBITDA. Let us take EBITDA is 100. So 100 into 30%. Okay, if you read this point, we need to make a deduction from 50. So that is 30 here. Net is 20. I'm reading this point again, total interest paid or payable in excess of the 30% of EBITDA. That means total interest minus EBITDA, 30% of EBITDA. The whatever that amount comes, that is the condition number 1. This is the maximum allowable expenditure as per the condition 1. Now, second condition. Second condition is what? Interest paid or payable to associated enterprise. That means this is the actual interest paid by one associated enterprise to another associated enterprise in form of interest. The actual expenditure. So, actual expenditure, let us say it is around 30. Okay, actual interest. Actual interest is 30. Now, in the condition 1 it is 20 and condition 2 it is 30 and it is allowed a lower of these two, then what is the allowable expenditure? That is 20. 20 is an allowable expenditure. So as per this condition, 20 is the allowable expenditure. On this particular portion only, majority of the questions will come. Okay, here the point to be noted is the total interest. That is first point. That means the total loans of the SSC will come here. There is a interpretation issue was there here. What do you mean by total interest? We don't go into that complication because some will say this total interest means only the interest which are payable to the associated enterprise only we need to cover. Those loans only we need to cover. Another interpretation is we need to take the total all the interest whatever the name will be total interest portion we need to take. Both interpretations are there. But we will go with the second one because by plain reading of this provision, it says total interest is not giving any exception to anything. So when I say total interest, whatever the loans the SSC is having, all the loans interest will come. In your examination, they are not complicating on this point. They are clearly giving only one loan transaction only for the convenience. So let us hope that only will come this time also. So in the examination, if you get this question, what you can do, you will see the total number of loans of the SSC and then calculate the interest. Then you take the total interest as part of condition number 1. This is simply you need to do. Now actual allowable expenditure as per this example is 20. Okay, and the second point where students will do commit a mistake here is they will give the net profit in the question. They will actually take that net profit and calculate the 30% profit. That's a error. That's a blunder. So you need to calculate the EBITDA. You take the net profit, add back the interest, add back the taxes, add back the depreciation, add back the amortization, then the EBITDA value will come. On the EBITDA value, then 30% you need to make. These 2 points you need to remember. Now I'm moving on to the next portion. Next portion is provision of guarantee and deposit of matching amount deemed to be debt issued. What does this mean? So they will make a simple arrangement. So I will just give you an example here. There are three companies: A Limited, B Inc, C Inc. Okay, and A Limited said that in India there is a provision called 94B. If you give the loan to me, if I pay the interest to you, that will be comes under this provision. Excess interest will be disallowed. We don't go into the complication. Then A Limited communicated that to BINC. What BINC will do is they don't give loan directly to the A Limited. What they will do is they will give the loan to CINC. So A and B are associated enterprises, but CINC is unrelated party. So BINC will advance loan to CINC, that is 10 lakhs. For example, loan amount is 10 lakhs. Then CINC in turn give that loan to A Limited, this 10 lakhs amount. This is the arrangement. Because C and A are unrelated parties, these provisions won't cover. So the government has identified this scenario and they have actually included a provision to tap these transactions. They said even if there is an arrangement something like this, then what this section says is it is assumed that this loan is provided by the BINC only, not CINC. Because this is the financial arrangement just to avoid the taxes. So to tap this provision was introduced. Similarly, BINC need not give CINC the amount, but they give the guarantee. You see, the BINC will tell to the CINC, you make the loan payment to the A Limited. I will give you the guarantee in case of default. In that case also, it is assumed that B Limited is advancing loan to the A Limited in an indirect way. Still, this 94B provisions will be applicable. That is what is covered here till here. Okay, I hope you understand this. On this thing only we are going to solve one question. On this example only, guarantee and deposit. Okay, one examination question. Now I'm moving on to the next area. Next area is what? Excess interest carried forward. What does this mean? We all know about business loss, right? Business loss can be carried forward up to next 8 assessment years. Similarly, whatever interest disallowed can be carried forward up to 8 assessment years. So what does this exactly mean? So in the above example, I told you that actual interest is 30 and the allowable interest is only 20. So actual interest is 30, allowable is 20. Then that means I have 10 rupees which can be carried forward. This 10 rupees will be carried forward for next 8 assessment years. Okay, how, as if carry forward is fine, how the set off will happen? How this 10 rupees I can adjust in the future years? So let us take an example. In the condition number 1, that means this condition number 1. Condition number 1 is what? Total interest paid or payable minus 30% of EBITDA. For example, if that comes around to around rupees 30 in the next year, I'm talking about in the next year. And second condition, actual interest paid is, for example, 20 and my actual interest is 20. So allowable interest is 30. That means condition number 1 and actual interest is 20. So what this provision says is, in any years out of these 8 years, in any year, if your actual interest is lower than the 30% of EBITDA, actual interest is lower than the total interest minus 30% of EBITDA, in that year, whatever the amount which is disallowed in the previous years, you can claim that as a deduction in this year. That means whatever is the disallowance of this 10 rupees earlier, we can claim that as a deduction. That means the total interest allowable for this year is 20, that is actual interest. Just a minute. 20, that is actual interest, plus 10 of previous year. Total 30. This is what this provision says. This is how the disallowed interest can be carried forward, up to 8 assessment years, and this can be set off in case if my condition number 1, that is total interest minus 30% of EBITDA, is higher than my actual expenditure. To the extent it is 30% of that EBITDA, condition number 1, we can take that as a deduction. For example, in this case, the amount which is disallowed is 20, not 10. 20. Let's revise our our example. It is 30 here, it is 20 here. Now my actual interest is lower than the condition number 1. I have a 10 balance here, but my disallowance is how much? 20. In this case also, I can take max to max 20 plus 10. So in no case my deduction should be higher than the condition number 1, that is total interest minus 30% of EBITDA should not cross. So this extra 10 rupees whatever is left over, I have to carry forward to next year because I have the 8 years gap. 8 years time is there. Okay, this is all about disallowance and the excess interest carry forward. Now I'm moving on to the exclusions part. As like every other provision, there are some exclusions also there. Okay, what are those exclusions? Exclusions from applicability of this provision. The first exclusion, I will go to the point number 3. If the interest expenditure, they are talking about interest expenditure, is 1 crore or below, then the provisions of 94B are not applicable. That means the total interest that the associate enterprise is making payment to the another associate enterprise in form of a interest. That interest amount, if it is 1 crore or below 1 crore, then the provisions of section 94B are not applicable. That is the point number 3 says. Why they put this condition is they don't want to disrupt the simple transactions or small financial arrangements. They want to only concentrate on the big ticket items. So they put this condition to identify only the big ticket items. Okay, any interest is 1 crore or below, then these provisions are not applicable. Similarly, these particular provisions are not applicable in case of a banking and insurance companies. Banking and insurance company, this is not applicable because banking and insurance company, they have their own regulations. That is first point. And banking and insurance company giving loans and taking loans, this is very normal scenarios, right? Lending is their main business. So and even for the banking company. So banking and insurance companies, these provisions are not applicable. And the second point, interest paid to debt issued by PE of a non-resident in India. A non-resident is there and there is a permanent establishment for that non-resident. There is a permanent establishment in India. This PE is given advance to an Indian company. So technically, this permanent establishment and the borrower both are situated in India only. That's why this provision is not applicable. Logical. This is point number 2. Point number 2 simply says the interest paid on debt issued by PE of a non-resident in India. PE is also exists in India and the borrower also exists in India. That's why these provisions are not applicable. So there are 3 conditions where this section 94B are not applicable. What is that? What are those? The first one, The first one, banking and insurance companies. Banking and insurance companies, section 94B is not applicable. And the second, if the loan given by the PE of a non-resident which is situated in India to another Indian company, then these provisions are not applicable. And the point number three, the interest expenditure total payable during paid or payable during the year, if it is 1 crore or below, then these provisions are not applicable. This is the exclusions part. Okay, now we have covered all the points of this provision. Now we are going to see one examination questions. With that we can conclude this provision. Now question number 7. Question number 7 was asked in the CA final examination, CA final May 2018 examination. Important question, but a simple question. Okay, this question is having a two parts. First part is relating to the whether this particular transaction comes under section 94B or not, whether this particular loan transaction comes under section 94B or not. Further, we need to see whether there is an associate relationship exist or not. That is a part 1. And part 2 of the question is relating to the calculation of excess interest as per section 94B. So first part of the question number 7. X Limited, a resident Indian company, on 1st April 2017 has borrowed 100 crores from AINC, a company incorporated in the USA. They took 100 crores from AINC, okay, at an interest rate of 9% per annum. Interest rate is 9% and the loan tenure is 10 years. Further, loan is guaranteed by BINC incorporated in the USA. Another company, BINC, has given a guarantee, to this loan. And Messrs. KINC and the another company KINC, a non-resident, holds shares carrying 30% of voting power both in X Limited and BINC. So X Limited is an Indian company and BINC is another company. On this, both the companies, KINC is having a 30% stake. Messrs. KINC also deposited 100 crores with AINC. KINC has deposited 100 crores. Whether this is falls under section 94B provisions or not. Let me go to the summary that I have prepared for this question. I already prepared a summary. Let me go to that to explain this question better. So this graph that I have made, I know this not looks that beautiful and attractive. I tried making something good, but this is how it looks finally. So to explain you better, I made this. So first of all, KINC is one company. KINC is having a stake of 30% in X Limited, Indian company, and BINC, non-resident. This is resident, this is non-resident. In both the companies, KINC is having a 30% stake. That means, can I say X Limited and BINC are associated enterprises of KINC, as well as X Limited and BINC both are associated enterprises. Okay, if you have remember the associated enterprise definition, you will able to relate to this. So both X Limited and BINC are associated enterprises. KINC, X Limited, BINC are associated enterprises. Now I will move on to the next. So what is the actual transaction here? AINC, a company, unrelated party, has advanced a loan to, this is unrelated party, AINC is unrelated party. AINC has advanced a loan of 100 crores to X Limited at 9% per annum interest. Okay, so advanced a loan. And here BINC gives a guarantee to this loan, guarantee to AINC that I am giving a guarantee for the loan that you are giving it to the X Limited, that BINC has did. Similarly, KINC, associated enterprise, has given a matching amount of 100 crores advance to AINC. KINC has given 100 crores. In turn, AINC paid that 100 crores to X Limited. If you remember, we have discussed about the similar point when I am discussing about section 94B. There, it is in these similar cases where the matching amount or the guarantee given by the associated enterprises, then in those cases the loan itself is assumed to be granted by the associated enterprises only, even though that loan actually advanced by the A Limited, that is an unrelated party. In this case, as the associate enterprise is giving the matching amount to unrelated party to give that loan in turn to its associated enterprises, then this arrangement also covered under section 94B. In these cases also excess interest needs to be calculated. Now to give you a better clarity, let me go to the provisions here. So I'm talking about this particular area. Provision, and here this particular provision that I'm talking about, provision of guarantee or deposit of matching amount deemed to be debt issued. deemed to be debt issued if the unrelated party where the debt is issued by a lender which is an unrelated party but an associated enterprise either provides guarantee or deposit. Here BINC is providing guarantee and KINC is providing a matching amount. Both are associated enterprises to Excel Limited. So in this case, the loan given was covered under section 94B. For the interest, we need to calculate the excess interest here. That is the part 1 of this question. That is the part 1. Now I'm moving on to the part 2. Yeah. Other information. So under other information, net profit of Excel Limited is 10 crores after debiting interest depreciation of 5 crores and income tax of 3.4 crores. Why they are giving this information? Because you need to calculate the EBITDA, that is earnings before interest, tax, the depreciation and amortization, right? For that they have given this information. Calculate the amount of interest to be disallowed under the head PGBP. In the computation of methods Excel Limited, substantiate your answer with the reasons. So, okay, this is the question. Second part is very simple. You need to calculate the excess interest. First of all, under excess interest under section 94B, how do we calculate the excess interest? What is the disallowance of? How do we calculate that? There are two conditions, right? First condition is related to total interest paid or payable in excess of 30% of EBITDA. So for this purpose, any question which you will get from under section for this 94B interest limitation question. So first you need to calculate two working notes. Working note number 1, that is total interest. Working note number 2, EBITDA. So if you calculate these two, question becomes very easy for you. First of all, the total interest. Luckily in this particular question there is only one loan. There is only one loan. So working note will be very simple. If there are multiple loans, you need to calculate the total interest by taking all the loans into consideration. The first of all, the working note number 1. Working note number 1, calculation of total interest. Calculation of total interest. Just a minute. Yeah, calculation of total interest, working note number 1. Interest paid or payable by Excel Limited is 9 crore. Interest paid or payable by Excel Limited is 9 crores. How does 9 crore came? 100 crores is the loan and 9% is the interest rate. Right? 9 crores is the first working note number 1. And working note number 2. Working note number 2, calculation of EBITDA. They have given the net profit to you. So they have given here the net profit to you. To that net profit, you need to add back. You need to add back interest which is already debited, depreciation, income tax, amortization. In this question, amortization was not there. If it is there, you need to add back that as well. So EBITDA we got 27 crores 40 lakhs is the EBITDA. So you have these two things now. Now you can calculate the disallowance part, excess interest very easily. So what we need to do is we just need to apply the formula. We just need to apply those conditions here. So what are those conditions? How do we define the amount of disallowance here? The condition number 1, total interest minus 30% of EBITDA. Total interest in excess of 30% of EBITDA. I would say total interest minus 30% of EBITDA. It will mean it's one and the same. So and condition number 2, actual interest paid or payable to its associated enterprises, whichever is less. That is the condition, right? So to computation of interest to be disallowed as per section 94B, computation of interest to be disallowed as per section 94B. So particulars, and interest paid or payable in excess of the lower of the following, total interest in excess of 30% of EBITDA, that came to 78 lakhs. So 78 lakhs, how it came? Total interest 9 crores minus 9 crores, how it comes? 100 crores into 9%. 9% is the interest rate and 30% of 27 crores 40 lakhs. This is the EBITDA we have calculated. That is 27 crores 40 lakhs. That is the EBITDA. 30% of EBITDA, total interest minus 30% of EBITDA. That is the condition 1. How much it is? 78 lakhs. Now total interest, actual interest paid to its associated enterprises is 9 crores. So the condition is whichever is lower. That means 78 lakhs is allowed as a reduction. And interest to be disallowed. What is the differential interest? 9 crores, that is the actual interest, minus whatever is the allowed interest, 78 lakhs. That remaining amount of interest is 8 crore 22 lakhs will be disallowed. This disallowed one can be carried forward up to 8 assessment years. Okay, this is what the provision, this is what the application. Now one note here. So if you want to solve this section 94B related questions for your practice, go to the study material and solve the question. And don't try to look at the suggested answers, especially this question in the suggested answers in May 2018, because they calculated in a different way. This particular table remaining everything is same. In this particular table, total interest excess of 30% of EBITDA, their calculation is different. They followed a different approach in study material and different approach in the suggested answers. So I think the whatever that was given in the study material is the right approach. Every tutor I have verified in the other tutors also, it is the one and the same. They are following the same way of structure here. This is all about section 94P. I hope you understand the provision well. Okay, and this question also very well. Now we'll move on to the next provision.